Dear clients, I'm Richard, Senior Phillip CFD dealer. US stocks backpedaled last week as equity market participants are apparently worried over whether equity valuation will be able to withstand the up-anchoring of the Fed's low interest rate era. I believe this is a key market concern intertwined with global geopolitical unrest and global monetary policy divergence, which contributed to the S&P index surrendering all of the prior week's gains. This worry is even more evidently revealed by the worse-off performances of the higher PE equity benchmarks such as the tech-heavy Nasdaq Composite Index and the smaller-cap Russell 2000. As a quick recap, during the Q2 US earnings seasons in April this year, equity market underwent a similar episode of stretch valuation concerns of high PE stocks due to improved rate hike prospects back then. Fortunately, equity market sentiments was subsequently buoyant by a welcoming stream of stronger than expected earnings reports, which further joisted the street to raise the Q3 US earnings outlook. And now, here we are. Alcoa, as usual, will kick off Q3 US earnings seasons next week on 8th of October. So the question to ponder is, should equity market participants once again pin their hope on clearing the raised earnings hurdle to dissipate this round of equity valuation worry? Well, to put things in simple perspective, we are much closer to a macro unwind than the prior quarter. This round of rekindling of equity valuation concerns has arrived in the context of US QE being on track to end this month, which has sent markets to scramble through equity economic data and policy language to establish changes and trends. As of now, market consensus signaled the first rate hike to take place somewhere in mid-2015, which is in itself almost a 9-year wait after the last rate hike happened in 2006. Hence, a key takeaway that market participants will be looking forward to in the upcoming October 28 to 29 FOMC meeting is whether the Fed will finally set a timetable for raising rates. Meanwhile, on the back of September's FOMC reiteration that forward policy directions will be data guided, good news on the US economy relative to other major economies seems to have played a role in dampening investor sentiments. For instance, last Thursday's weekly jobless claims stayed below 300,000 level, an indication of ongoing healing of the labor market, coupled with last Friday's announcement that the US economy has grown at its fastest pace since the end of 2011, further worries about change in Fed policies. In terms of cross-market actions, high-yield bonds have noticeably weakened in parallel with the equities markets, an indication that market participants are growing more risk-averse. As such, US Treasury is a preferred safety refuge for now, given that it offers a spread over the average G7 sovereign yields against a backdrop depicting that global growth may be stalling. In the FX space, the US dollar strengthened 6.7% last quarter, the biggest advance since the third quarter of 2008, based on the Bloomberg Dollar Spot Index, which tracks the greenback against 10 major peers. Hence, it came as no surprise that the US-denominated commodity complex, based on the Bloomberg Commodity Index, bear the brunt of the stronger US dollar, slumping 12% in the third quarter, the most since 2008. To sum up, the cross-market price actions as illustrated above are currently exhibiting a clear risk-off environment. This assessment is in line with my last commentary, whereby clients are advised to consider harvesting their equity gains amid global policy divergence risks that could trigger concerns over a premature US policy tightening. It is conceivable that this remains as a dominant theme that resonates across markets, thereby elevating the risk of an autumn equity correction. As such, until cross-markets show signs of stabilization and more policy clarity are viewed, it is prudent for equity market participants to remain agile and consider de-risking their market exposure into pockets of market strength. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Richard for Phillip CFD. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.